Before you guys got acquired by Swiggy, what did you use more, Swiggy or Zomato? You have to be true.
Zomato.
Our guest today is Sahil Jain. Sahil co founded Dineout, and Dineout was acquired twice. First by the Times Internet Group, followed by Swiggy in 2022 for an estimated $200 million. We hear from Sahil today about his ups and downs as a founder, his angel investment philosophy, and his relationship with money. Enjoy this brand new episode of First Unicorn Chats.
Sahil, welcome to First Unicorn Chats. This is your first in-person podcast. How are you feeling?
I'm feeling excited at the same time a bit intimidated.
Not intimidated. You should be excited.
Yes, I am excited. Yeah, absolutely.
I'm going to start you off with a very easy question so that you're not intimidated.
Right.
Right? You're most known for your exit to Swiggy, right? And that's another story that we'll unfold during the podcast. But I'll start with a very softball. Before you guys got acquired by Swiggy, what did you use more, Swiggy or Zomato? You have to be true.
Zomato.
Oh, why is that?
No, see, okay. See, both Swiggy and Zomato have their geographies, right? If you look even now, Zomato is a very north-heavy sort of app, whereas Swiggy is south-dominated. Even in terms of market share, Zomato has a higher market share in Delhi versus in a Bangalore or a Chennai, Hyderabad,
Right.
right? So, in general, if you look at people in Delhi, they tend to use Zomato more. I don't know if it is just a persona of the app, like each app has its own personality, right? In terms of the UI, UX, like in general, right? So I think being in Delhi, I think Zomato was the obvious choice. It was there much earlier, even before Swiggy, right? Even when we started Dine Out way back in 2012, Zomato is something that existed. So Swiggy came back much later on. So I think it was a legacy thing which continued, especially being in Delhi, right? So
Right. No, that's a very interesting observation because I live for I think 3 years in Bangalore.
Yeah.
Right. I almost exclusively use Swiggy.
Exactly.
And I moved to Delhi, and ever since I've been using Zomato.
Yeah.
Right. So good, interesting start. But I'm gonna come back a little bit. Right. Sahil, tell us if you were to introduce yourself in the most interesting way, like you would to a friend, not the general, hi, this is my business card, I'm Sahil Jain. How would you do that if you were introducing yourself to a friend? Who is Sahil?
Who is Sahil? Well, I would say that I'm a guy like people will not imagine. Like way back in college, I was a guy like, into rock music, long hair, stuff like that, right? And today, obviously, it's a very different personality. But if I were to talk to my friends who know me for a while, they know a very different side of me versus what I am at work, right? So it's like party hard and then work harder, right? That's the theme that I run with. So with friends, it's a very chilled out scene where I can sort of enjoy with them, party hard with them, and then obviously go back to work and work harder, right? So that's who I am.
Oh, that's very interesting, yeah. So I did my research, right? When I was, preparing for this podcast, there was a partner at BCG who had recommended you on LinkedIn. I think the words were, "I have never seen Sahil panic." I think this was like a 15-year-old reco, right? Are you still, after being through, so many things in the startup ecosystem, 15 years, are you still the same person? Somebody who's always, not
I
panicking?
I would say so. I believe that I tend to have that calm, patient sort of outlay even in the worst of times. And I think I've taken a lot of feedback from people, right? Including folks who work with me in my team, etc. And I think, yeah, I think that is one quality I try and sort of maintain. And, I don't know, it comes naturally. It's not like I've worked upon it or something which I've developed over time. It is more of a natural thing which has gotten better over time, I would say, right? With different experiences, different situations, you realize that panicking never really helps, right? It just leads to worse decisions and worse outcomes if you were to panic. So
Have you, in your, story with Dine Out, have there been situations where you've seen people around you panicking, right? And you're like, no, I have to kind of be that pillar of stability here because Dine Out was a big success story, and we will unfold that in this conversation. But would love to hear, some of those instances where, hey, you realize that there's a lot of panic around, but you knew that inside you had to be the one who had to be stable.
I mean, yeah, I mean, there over time there would be multiple stories where, let's say, competition would have done X, Y, Z things. It could be on the business side, sales side, or on the product, where they would have done something where the team would sort of come back and say, "Hey, what do we do here?" Right? And at that point, for me and as well as my other founders, was the idea was to figure out what can be the right solution here, where we can not focus on competition and see what is right for the business and build for the long term, right? And I think that is what we've done. Obviously, we were always cash crunch in the sense we never had like millions of dollars to burn, right? Because we never raised large rounds of money, right? Being with times, the good part that we learned is how to be frugal with money and still figure out solutions to dominate the market, right?
Right.
Even in that situation, I think in the dining out space, we've always been leaders in terms of the number of reservations we did, or now the number of payments that are happening through our platform. We've always maintained that dining out supremacy, even with competition having lot many more dollars to burn, right?
Right.
So
I think this is a good segue. Let's unfold the story of Dineout, because now it seems like a big success story, but it's been more than a decade into the making, right? From your times in London, unpack that for us. How was that?
So, see, the four of us, we're four co-founders, right? And we go back a long way, right? We know each other since we were 5 years old. For all four of us, right? We were in the same school since nursery. We grew up as friends, and we always had a thought that sometime in life you want to start up something. Right? That was something which at least I had in my mind forever, that I would want to build a business at some point in my life, right? And obviously, post school, we went our different ways. I did my engineering in Bangalore. Ankit was in London. Vivek was in Merchant Navy. Nikhil was in Delhi with in the banking services and stuff, and we were doing different stuff. But eventually, in 2010, 11 is when we said that now is the time that we want to sort of start up something. We've spent a lot of time in the corporate world, burned midnight oil for other companies. Now is the time to sort of spend time to build your own company, right? And that's when
Right.
we said that let's get together and figure out how to build this. I The interesting story there is that I was actually working in Seattle with Microsoft, right? And Ankit was in London, and he called me that, hey, this is an idea. This was in October 2010 or something. What do you think about it? And I said, yeah, it sounds interesting. And I took about 10-15 days, did a lot of research, what to do, etc. And like in a month, I just resigned and I said I'm going back to India. And I just called up Ankit, and he's like, whoa, what's happening? How come you're moving so quickly? I was like, no, I think this is what I want to do now. And I'm moving back. When are you moving? Right. And he was in a sort of a bad situation because he'd lived in London for I think about 9 years already. And he needed to spend another year to get that PR or something. 10 years you spend, something like that, right? And he also had a CFA exam. But then I pushed him, and then 6 months post the CFA exam, he also sort of moved back to India to sort of start building this, right? And he missed out on getting that PR, whatever. And till date, he sort of blames me for that. But that's how the whole story started. And eventually, then Vivek and Nikhil also joined us through the next 6 months. And finally, we launched Dine Out on 29th Feb 2012, which was like a special date, leap year. We're like, let's work backwards from this date and launch the company. And that's when we finally launched it.
Oh, wonderful. I think I'm sure he doesn't blame you anymore because you guys can pretty much buy your own PRs if need
Yeah,
be.
yeah.
But very interesting, that you guys kind of got in around 2012, right?
Yes.
That's also overlapping with the ecosystem coming of age, right? And it's only, a few years after I think Flipkart got its first main check.
Correct. I mean, at that point, there were no mobile apps. Like when I tell people 2012, people didn't know what a mobile app is. 2013 or 14 was when people started talking about mobile apps. So we were thinking of only websites in 2012, which sounds funny when you think about it, right? And we said that we need to launch a website, etc., and have a call center at the back end. And that's how we launched, in fact, in 2012, the business.
So at that time, was there like a sense that, hey, this is the market, this is from an F&B standpoint?
Yeah. Yeah, so what happened is we studied all the other markets. So there was Open Table in US, there was Top Table in UK. And what we realized is that they had obviously gone B2B first, where they built in SaaS softwares for restaurant partners, which they could use, and then build a B2C business on top. But in 2012, like going to restaurants and saying that, hey, this is a SaaS software that you need to use, like the restaurant said, run away, man. I mean, they didn't want, they were not interested in buying any software, right? They were like, hey, boss, first show me the dhanda, show me the money, right? And that's when we pivoted. Like even before launch, we said that we're going to go B2C first and not try and sell software to these restaurant partners. Let us first show them some money. That's where we launched Dineout as a pure play reservations platform from day one in
Right.
2012. So
I think at this point, I'll just touch upon the fact that how hard an industry F&B is, right? My family is into F&B. I've never got into it, right?
yeah,
And precisely because I understand how hard it is, right? Margins are slim, and from the outside, what you get is cheerleader effect, right? You see those one or two
exactly.
restaurants doing really well, and you're like, but बढ़िया business है, let's go into this, right? But you miss out on the 99% which are not making money.
Correct.
How did you guys kind of arrive at that ki yaar, we will try to make this, this longer tail of restaurants, we'll get more money to their pockets, because that's the real way that you guys got the value that you did.
Right.
Correct me if I'm wrong.
Correct. See, if you think about the F&B industry, like they had no channels to advertise themselves, right? Way back in 2010, 11, whatever, right? There was maybe just a Just Dial. I mean, people weren't even using Google for that matter to search for restaurants, right? So people would just call up Just Dial and say, "Can I get a restaurant in CP?" And they would get some random SMS with 5 restaurants, probably, right? I mean, that is how it was, right? So what we realize is that if we can give the restaurants a dedicated channel where they can actually reach out to customers who are looking for F&B places, the CAC will go down for the restaurant partner, and it democratizes the whole thing for even smaller restaurant partners. See, the larger brands have money to blow, right?
Right.
Whether it's a big chain like a Pizza Hut or a McDonald's, or even larger F&B chains, they've got a lot of money to blow on marketing, right? But a smaller single restaurateur doesn't have that kind of money, and they don't understand Facebook, Google ads, etc. Here it was a simpler platform where we were giving a chance to these younger brands to come on board and sort of reach out to their customer base, and it worked fantastically well for us, right? Because we were able to send a lot of business to these single owned restaurants, and they could really appreciate the value of Dino being a marketing channel for them.
Right. So that starts at 2012, right?
Yes.
Let's cut to 2022. 10 years later, what was that journey like? Where had you guys felt that you brought Dine Out to?
Okay, so I'll actually break that out into two phases, right? Because three phases actually, because 12 years is a long
Right.
time period, right? When we started in 2012, we were a pure play reservations platform, and we did that till about 2017, I think, right? But that's when we realized that reservation as a market, right, in India is kind of uh, it's not it's like unsaturated, it's very young, but the demand is low, right? The demand for is for something else, and that's when we switched to payments as a product, where we said that this is more convenient for the user to use, where they can easily understand that when they pay they get a sort of a discount, and easier for us to monitor, right? Because earlier what our model was that I would send you reservation and I'll charge you per reservation. Now in US it works really well, they charge $1 per diner, right?
Hmm.
In India, we did the same model, 50 rupees per diner, for example. The challenge we faced operationally is I would send you 100 customers. The restaurant would say, no, 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 boss, only 30 people came, right? And that reconciliation was a crazy process, right? We couldn't dedicate bandwidth on that and then still scale, right? And it works well in Europe and US, but it does not work in India. So one more call out I have is that everything that works outside India does not necessarily work the same way in India, right?
Absolutely.
So that is one learning that we had, and that is when we pivoted that, hey, we cannot be only a reservations play, and we moved to payments, right? And today we are the largest payments platform for dining out in the country, right? That was one shift that we made in 2017-18, which helped us scale our business like 10x, right? Like post 2018, 2018 to 2020 was a very different journey between versus 2012 to 2017, which was a slow growth
Right.
period for us, right? And 2017 to 2020, just before COVID hit us, was like a crazy growth story, right?
Right.
That is one part, and then the last part is the post-COVID part. So I don't know, we
Right.
can cover that a
We'll,
bit.
we'll put a pause there.
Yeah.
Around this time that you guys pivoted, right? Was that the pivot which actually gave you an edge over folks like Easy Diner and the guys who were in the market at the time?
Absolutely. See, Easy Diner came in much later, right? I mean, there we started in 2012. Easy Diner sort of came in 2015, 16 maybe. And there were two, three other players as well at that point in time. But they were again all focused on reservations, and we were the ones who first innovated on getting into payments, right? And for a long time, nobody even tried to get us. So we had like a green path to scale payments, right? Nobody was competing, whether it was Zomato, Easy Diner, nobody, right? So we became a default payments platform for people who wanted to pay through the platform. And that is where we were able to scale up very fast.
Right. And then comes the post-COVID time, right? I think
Correct.
let's talk about the COVID time. What happened? What was the COVID time like for you? Because for every entrepreneur, they have a different story,
Yes.
right?
For us, it was crazy, right? Like March 2020 happened and we didn't know what hit us, right? And because April, May, we were like shut shop, right? Because delivery was still on because the government had allowed people to order and get food delivered to their homes. But dining out was shut. Like all our restaurant partners, we had like 15,000 restaurant partners, they were all shut.
How much did the revenue drop by in that
Zero.
zero from?
It was zero, from X crores to zero, right? So
Right.
February 2020, we did the Great Indian Restaurant Festival, which was our largest festival, highest GMV ever, lifetime high, right? We did about like a crazy number. March was going well. Mid March, all these news started coming in, and April we were shut, and we had a team of about 700 people, and we didn't know what to do,
What did
right?
you do?
So April, May completely shut. Um, so luckily we had two parts to the business, right? There was a B2C business and there was a B2B business where we had a product called InResto, where we were giving them stuff around POS, table management solutions, ordering solutions, etc. So we tried to figure out a way if that could be a product that we could scale for COVID times, right? Because restaurants wanted technology to reach out to customers, maybe for ordering or even for dine-in if it is opening up, where there's no touch of the menu, etc., digital ordering and stuff. So we created solutions around that and started selling that to restaurants. We said, hey, okay, we're down to zero, but we can't like shut shop. Let's figure out other revenue sources. And then May is when we decided to start selling these B2B products, etc. And we got a lot of traction. We got almost about 3,000-4,000 restaurants to sign up on the product, and they started sort of using that product for reaching out to the customer base, etc. Um, and then slowly, I think in June or July, the industry started opening up. Some of the restrictions were lifted and the restaurants started opening up. So they were using our products and we started getting some of the mojo back. But 2 months, we were like, boss, what will we do with such a large team? And the entire Times group, like, I mean, they were also pushing us to figure out cost savings, cost cutting, how can we manage the P&L and stuff, right? Otherwise, it was a massive burn with the fixed cost sitting on your P&L, how to manage that. Obviously, somewhere down the line in October, November, I think like every other business, everyone did some right sizing of the team, which we also did. But the point was that we didn't have to shut shop. And in fact, we came back so hard that within 6 months, right, like by December 2020, we were back to normal. So that whole revenge consumption thing was very real, right? We saw incredible, response from the customers who came back onto the platform and were dining out even more. So that was fine. But what hit us harder was wave two. So when all of this was happening, we again said, oh, things are great. Let's go back to normal. Things are going to be fine. And April 2021 was when wave two happened, right? And that was bad. Like, I mean, in the country, you were seeing people dying left, right, and center. And I mean, personally as well, there were a lot of things which were going on, right, for people. And at that point, we didn't know what to do. That time, we were like, this is crazy. That entire month of April 2021, I remember, I don't think any work happened that time. And again, restaurants were shut, etc. But we said, after some time, obviously, the first 10 days were really bad. But then we realized that wave one happened. We came out of it. Let's just wait our way out and see how it goes, right? And so that happened. And after that, it has been a crazy story, right? Once that wave two got over, in the previous wave, it took us 6 months to come back to normal. This wave, the revenge consumption was so much higher that we were back to normal in 2 months. So by June 2021 or July 2021, we were back to our pre-COVID numbers. And by December 2021, we were 2x,
Right.
right? And that is when, in this period is when our conversation even started happening with Swiggy, etc., all of that, right? So this was something which we had been talking with them for a while. Nothing materialized because there were questions on the actual business itself, right? That in COVID times, will this work, not work? Is this business even worth it, right? But post this entire wave one, wave two journey, the fact that we survived, we went up 2x is what I think gave everyone confidence that this is a business which is here to stay with a large market which can grow. So that was the journey till 2022.
No, very interesting. That takes us. So basically, you were in 2020. Just to recap, with zero revenues,
Yes.
right? Having just 2020. So you've now been in operations for about 8 years. So after 8 years, suddenly when you see something that you build with zero revenues, that's going to hit hard. But that comes back in 6 months, only to go away again
In April,
in
yes.
April, and to come back stronger 2 months later,
Yes.
right? And about 12 months later, you guys are acquired by Swiggy. And
Correct.
what was the deal that you guys had with them? What is the deal value?
No, I mean, so I can't put that number out with the exact
It's
number,
all
but
out there.
but still, yeah, I don't know. There are these legal people. I'm scared of them. But anyways, but no, whatever happened, at least the good part was that for us, we got 2x the value that we would have got like a year back, right? Because
Yeah.
we were in conversation, and at that time, there were questions on the actual credibility of the business. Will this survive COVID times? What will be the dining out industry post COVID world, etc. So whatever number, at least I think we were thinking of, we got at least 2x of that in that 1 year
And
period.
that
So
you got in 2022, right? Right
yes,
at the edge of the funding winter starting
just before that,
and the interest rate cycle turning.
just before that, yes.
How lucky
So
do you feel?
no, I mean, extremely right. So I think we've been unlucky many times, so it feels good to be lucky a few times. Because what happened was, we are, I think one more thing is that we're the only company to have been acquired twice. Because in 2014, we were acquired by Times as well, right?
Right.
And now we got acquired by Swiggy from Times, right? In 2014, what happened was, between 2012 to 2014, we raised an angel round, right? And it was one of our own customers who liked the service so much that they came in and put in the angel round, right, for us. Post that, what happened was 2013, right? From mid 2013 to mid 2014 was the worst period for startups in terms of fundraising, right? The election was around the corner. People were not so happy what's happening, and it had completely dried up. We got a few options, but they were like really bad deals, so we didn't pick them up, right? And March 2014 is when we were talking to Times about some sort of an integration. We didn't even talk about acquisition or funding, right? And they came back and said that, hey, this looks like a great business. Why don't we acquire you? We've got the distribution, we can scale it. And it was a decent sort of deal in our heads. We said, we're not getting anything else and the market looks bad. Let's go for it, right? We went for it, March 2020. April, we joined Times. May, Modi ji came to power, 2014 May, and it was crazy after that. The way the funding started happening after May 2014, it was like $1 million were being thrown at any startup founder from an IM or an IT, even on an idea between 2014 to 2015. So if you see that 1 year period, you got like so many startups who got funding and then they suddenly died in 2016-17 period, right?
Right.
There were these taxi apps, there were a lot of these food delivery apps. Along with Swiggy, there were like 5 more guys. They shut down. Obviously, Swiggy survived, but there were so many such companies that got funding in that 1 year period, and we were like, did we do the right thing at that point in time? I mean, a few more months and maybe we could have raised on better terms and raised better money. But I think that's all retrospective. You've got to give credit where it's due. I mean, we went there, it worked well for us, and we are here where we are because of that.
Hindsight is always 2020, right?
Exactly.
But do you think the current environment, right? As you were speaking, if you just think about that, it's very similar to the
It's repeating.
2013,
It's repeating. Yeah,
right?
I feel.
Because 2014 maybe the interest rate was quite high.
Yes.
That's when the pivot had happened, right? So interest rate cycles turned. There was more stability with respect to the political environment. Aren't we in the same situation now?
100%. I believe that 2024 could be very similar to 2014 post election period, at least domestically, right? So I feel like it is going to repeat itself. That's exactly what I'm feeling right now.
What would you suggest to founders who are struggling today in the same place that you were?
I would say that you need to figure out a way to, survive for the next 12 months somehow. Any startup today, if they can survive for the next 12 months and stay afloat, I'm pretty sure next year, same time, June 2024, there would be a splurge of investors coming in to throw in big money in India because they would be confident that this company, which has survived this entire funding winter, right, the whole post-COVID period, they are in for the long run, right? So the confidence level also will be higher on the investor side.
Survival of the fittest.
100%.
And plus, next year, once let's assuming that there's stability with respect to the
Correct.
government, all of that capital starts to come back.
Correct.
You know what they say, right? History doesn't repeat itself, but it rhymes.
Yes.
So we might just see a repeat of that situation, right? I think it's a good segue to kind of move into your life post the acquisition, right? You got into did you get into angel investing right after this, or were you had you kind of
No,
started?
no. I think we got into angel investing way back. Even pre-COVID, we were doing small, like a few angel investments here or there. Starting in 2020, I would say, like 2019 is the first time I think where we ventured into angel investing. So it had been a year and a half since we had started doing it before COVID. But we had done like a couple of investments here and there. It wasn't really a very big focus area for us. But I think post COVID, I think a year after, I think wave two is when we realized that now this is the time where we should invest into young entrepreneurs, startups, which can become really big over the course of next 3 4 years. And that's when we started even finding, in terms of liquidity, right, around in and around us, a lot of friends and family, even colleagues who were sort of interested in diversifying and trying out other sort of mediums other than sort of mutual funds, real estate, beyond that, right?
Right,
And that's where we got a group of people who are interested in investing in startups, and they believed in our thought process. So we would go through a very stringent process. Being entrepreneurs, they would say that, hey, Sahil, Ankit, wherever you guys are putting money, we are happy to put money, right? So we went through that phase and we got a bunch of people onto our syndicate, and that's where it started growing. And now we've done almost, I think, 30 40 plus investments over the course of last couple of years.
I'm very curious about something, Sahil. When okay, let me break this question into two, right? What is your first reaction when you saw that money hit the bank, right? Post the acquisition. Uh, let's start with that. What was the first feeling? Was it satisfaction? Was it
No, I mean, obviously it's a sigh of relief that you've achieved something in the last 10, 11 years of uh, your work with the company, what you've built, right? But it also, the other thought is also that there is still so much yet to be done. There is so much more value in what we had initially imagined, and we are nowhere even close, right? I think there is still, when you see that there is still a 10x opportunity in the same business where you are, along with a newer partner, obviously now, then you feel excited that, hey, this is something I would want to sort of do in the next couple of years and actually reach that goal, which I had imagined at least,
no, it's very interesting, yeah. I was having a chat with a few because prior to this, whenever I had done a lot of M&As, right? Uh, Everyone that you ask this question to, it has almost the same answer, which is relief, right? Ki all the years that I had put into this, it's worth it, just that much, right? Funnily enough, most of them end up putting all of that money back into startups,
Yeah.
right? Why was that? Why is that the case?
Because okay, so it just feels that, but entrepreneurs by nature are high risk, high
High
reward
reward,
people, right?
yeah.
So malab, if you've got some money and if you're thinking 10 years out, I will put my money where I see the highest reward, right? Even though it is high risk. So automatically you gravitate towards that, where you end up sort of doing stuff where you park a large portion of your money in higher risk assets where you believe you've got higher reward, because at that point you're not thinking of making a living out of that money, right? That is not really
Right.
the intent, right? The intent is to see how you can multiply that better. And the second part also I'll tell you is that there is a need after doing something for 10 years when you're doing the same thing, that how can you give that knowledge back to the community, to people, and see if whatever you've learned, can you apply it on someone and give them a head start of 3 years. So what I believe is that if I can work with a founder and give them the head start, the learning that we saw, whether it is in terms of hiring practices, basic stuff, right? Not even like rocket science, right? These are the areas where people miss out on the most, right? What kind of people to hire, what kind of a team to build, what kind of a culture to have, how to think about product, what are the pitfalls of doing XYZ. If all of that can be coached, I think if I can give a founder a 3 year head start, right, versus where they are today, I think that is more valuable than the money actually that I'm giving, right?
Right.
And that is where I feel I would want to contribute and work with founders to give them that head start.
Right. No, I think that makes a lot of sense. एक बात बताओ साहिल, and this is something that is kind of going through my mind, going through a lot of people's mind, right? The number of frauds that have started happening in the
Hmm.
ecosystem, it's just shot up,
Yeah.
right? It started with kind of news in the US of FTX and whatnot, and now it's kind of casting like a dark shadow over the ecosystem, right? As an angel who invests in early stage, right? What is your thought right now from firstly your own investing philosophy versus let's say somebody who's asking you कि क्या fraud चल रहा है ecosystem में क्या करूँ मैं? So what is your mindset towards this?
See, we are typically the first check in the company, right? So we try and look for founders who are honest, who are dedicated about their work and passionate, right? These are like two or three things that we look for because, like I said, like we pivoted ourselves, and one of like two or three of our biggest return companies in terms of angel investment have pivoted twice in their journey, right? Not the initial idea we put money in, right? So we are betting 100% on the founder. So for us, the founder quality is extremely important because I believe that if the founder is right, they will pivot the idea, figure out some way to survive, figure out something to scale, right? So our investment philosophy is very simple, that we want to invest in the best founder quality, and we try and judge that on multiple levels. We obviously do our due diligence and stuff, understand their philosophy, talk to a lot more people in and around them, but you can do that only till a period of time, right? Post that, I think once they get into the higher sphere where they've got series A investments, series B investments, what goes on after that is something where we don't play that larger role, right? And that is where I feel things go wrong, right? Where some sort of greed probably kicks in and people sort of divert here and there. That is an area where I feel where people need to be a bit more careful.
Right. 2023, good time for early stage angel investors to be active, or is it a wait and watch time?
I think it is a good time to put in money in strong businesses where you feel that over a 5 year period there will be definitely good outcomes. Because, like I said, I genuinely feel that in a year from now, there will be this whole funding winter, whatever you call it. See, I don't feel, first of all, there is a funding winter in this early stage investments. The funding winter is higher up on series B, C, whatever you want to call it, right? That's where the funding winter is. At an early stage, I still see so many startups getting the money, 100K checks, 200K checks. These are something which are easily accessible today. So if you can get the right business and put that 100, 200K check, I think there is a definite opportunity in the long run.
True, but I think if you take early stage as up to Series A,
Yeah,
right, the drop in the last quarter has been almost 80%.
correct.
The
This,
fear actually is that I'll put in my 100K or 200K, right? It's not going to last you too long.
correct.
Where are you going to get the next check from,
Exactly.
right? So from a founder perspective, who's building in this market, right? Uh, how do you kind of wrap your head around capital efficiency in this market?
We need, see, what we look at is at least people who are in their minds philosophically thinking about capital efficiency, right? Today also, if I meet 10 founders, I see 8 of them are still living in that world where they see that, okay, so many companies have burned so much money and have arrived here, so why can't we get the same sort of push to get our products out? And I think those are the mindsets that need to change because we're living in different times, right? What worked in 2018, 19 does not work now. So you aren't going to get those millions of dollars just to burn. It has to be more capital efficient in nature. So I think even when we put money, we tend to put in business models and companies, founders who have that sort of mindset, right? So for example, like for me personally, like D2C as a space looks very tough. So in general, for the last 6 8 months, that is a space I'm absolutely not looking at because it is a high burn business with very difficult outcomes. So those are areas which we try and avoid where we feel this could be a problem in the next sort of 12 to 18 months.
Very similar. That's a very similar mindset that I have towards D2C, right?
Yeah.
My mindset is that because it's such a huge consumer market, right? Doing a 0 to 1, right, is very easy in a consumer market because इतनी बड़ी market है to consume,
हाँ,
right?
correct.
So the chance of you getting a false positive is extremely high, right? Because the scaling is the tougher part, right? 1 to 10 is hard and 10 to 100 is harder.
Correct.
And I genuinely feel that D2C के लिए you need like specialist skills, right? As an operator, as a VC to be able to kind of spot the winners,
Correct.
right? But no, very interesting. I think these are very interesting times that we live in. I have one final question for you, right? Before we kind of end this. Uh, Life has been kind of a full circle at this point, right? For you as an entrepreneur. Has money changed you in any way that you are aware of?
Has money changed me in any way? How? I don't think so. I think, I mean, obviously, you get a bit more comfortable in your lifestyle doing a few extra things that you may not do, like an extra holiday here or there, buying a few things here or there. But in general, I don't think it has changed the way I think or, approach life in any form. I think that is something which I try and not. Let affect my lifestyle, right, in a big way. So I mean, probably you get some more money, you probably invest a lot more, probably into real estate, into startups, into other assets, right? But that's it, right? I mean, when you have a little bit more, you invest
Right.
more. That's the only thing I would say has changed in my mindset when I think about it.
Also, there's a lot of stigma around money in India, right? That especially if you do make money, it's uh, basically you want to not go over the top, or kind of flaunt in a very different kind of a way. Did that societal thing kind of, because having come up through a middle class upbringing, was that something that was on your mind when you came into money?
Not really. I think, and especially living in Delhi, you see so many other people who are
Naturally.
spending spending a lot more and showing off a lot more that you feel that you're like nowhere even close to that sort of culture, right? I mean,
Right.
if they're at 10, you're probably at 2 or 3, and then that's where I'm like, it's okay. But then on the flip side, if I would go to a Bangalore, it's a completely different market, right? There
Right.
would be another guy who could be 10x in size, but living a lifestyle which is
Correct.
half of what you're doing today. So different, like I said earlier, right, different geographies, different people, people look at things very differently. That's what I've realized over time. So you just got to do what you want to do. So
Plus, I think there's also the whole diminishing returns, right, of money and capital after a while.
yeah,
Uh,
correct.
anyway,
So
Sahil, this has been a wonderful conversation. Thank you for your time today, and we hope to do this another time.
absolutely, thank
Thank you.
you.
Summing up our conversation with Sahil with three top takeaways. Number one, to be a successful founder in 2023, you have to be capital efficient. You cannot fundraise before actually establishing a sound business model. Number two, history doesn't repeat itself, but it rhymes. 2023 is very similar to 2013. Lesser liquidity, higher interest rates, and an upcoming national election. We saw liquidity and capital rush back in 2014 to fundamentally sound businesses, which ended up leapfrogging their peers. We can expect the same in the second half of 2024. Number three, invest in the future by investing in startups. Despite today's corporate governance issues with startups, it remains the most promising asset class to invest in the technologies of tomorrow. We hope you enjoyed this episode of First Unicorn Chats. We hope to catch you in the next one.